then we have to understand what is the purpose for which the report is prepared. Maybe the report is to explain something or analyze the situation or advise someone, then critically evaluate. Whatever is the reason for which a report has to be prepared, first understand what is the purpose of preparing the report. After the purpose is understood, then who's the audience for this, for which the report is being prepared? Whom are we addressing? That something like a report writing, letter writing, which you have learned in your school days, something like that, similar to that. So you have to follow the structure of it. To whom are you addressing? What is the purpose of the report which has to be prepared? And what information should be included in this? What information is needed? After that, what layout is suitable to address that particular issue? That is, what layout is suitable.
So, ma'am, in this case, the audience is the shareholders, right?
No, 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 no. It could be like you are writing a letter to CEO, you are writing a letter to someone in the organization, um, asking for the sanction of something, or the CEO wants you to, or CFO, someone in the organization wants you to explain about a particular um, a method or the situation, or give him an analysis of the financial statement, something like that. So that particular thing, when you are explaining or including that information and sending it to them, that person is the audience. Could be anyone in the organization. We're not all the time communicating with the shareholders or the investors. It could be anyone in the organization. That's why we have to understand what is the purpose of the report. So why are we preparing the report?
Okay.
The report which you're talking about is about the annual reports which the organization prepares and which are kept available for everyone, all the stakeholders. Okay, that's the that those are annual reports. Here, a report where it is prepared to address a particular person or persons in the organization, depending on whatever is the situation.
Okay, sure. Thank you, ma'am.
Yeah. Then, what is the pattern in which the report is prepared? We have next topic is what are the types of the, uh, data, quantitative data, qualitative data, and what are the problems associated with quantitative data. Now, quantitative data is collection of data, and to collect the data and data process the data. Quantitative data is in the form of numbers, facts, figures. Those things we call that as quantitative data. So this has to be processed. So collecting and processing is a problem, because collection of data is not a simple task. Then arranging the data, then taking it for processing and analyzing is a difficulty in that. Then failing to look for underlying causes. Only the facts are looked into. What is the reason behind that is never taken into consideration. So only the underlying causes are, only the figures are taken, not the underlying causes. Then looks at figures in isolation. Then failure to use a suitable comparator or benchmark. The data is considered in isolation, so that do not convey the meaning, that do not convey what is the performance of it. But if it is compared with the some other competitor, another comparator, it could be internal, external, within an organization, with another unit or division or department, or with another peer in the market, competitor or someone. So if that is done, then it makes some sense, it is meaningful. Otherwise, the data which is looked at in isolation may not convey the actual the performance measurement is not possible in such situation. Then some of them cannot understand the percentages. When they're converted into percentages, they are not easy to understand. Some of them fail to understand when it is given in absolute figures. So absolute figures only talk about the figures, but then relatively they do not convey the message. Percentages convey the message in a relative sense. So one variable is compared with another variable and converted into percentages, but that cannot be understood by some stakeholders. So that's a disadvantage. Then if the data is large volume of data, then only samples are selected. Then the entire the entire population is not considered, but only a sample is selected. So then sample is taken for test, and then that sample test is applied for the entire data. Fine. But what is the guarantee that it is a true representative of the entire population? That is another problem with large volumes of data. Then there is something called as confusing correlation and causality. Correlation talks about uh, building a relation or finding out the relationship between variables. So two variables, what is the relationship between them? When it is calculated, that we call it as correlation, finding out the relation between two variables. So with the help of correlation, it is possible to establish a trend. The trend can be established. Then we can understand how do they move, what is the impact of one variable on the other variable, and so we can find out the trend. But if the trend is already established, then every time that the data is taken up for analysis or interpretation, this the trend which is already established makes the person little biased towards the data. The trend is already there. Then whenever it is taken for further research, then uh, it could be a little biased because the trend is established. But causality eliminates that trend from the data, and the data is taken for further research. So correlation is establishing the relationship and establishing the trend. Causality is removing the trend from the data. Right? What are the problems with dealing with qualitative data? Qualitative data is not in form of figures. It is in the form of opinions. So it could be biased. Someone has expressed their opinion. It cannot be a fact. It could be I mean biased, a subjective opinion. Someone has given that. So that issue of being biased or it is not considered as a fact that is always there, can reduce subjectivity by looking at trends in performance. Then the next topic is about how is performance measured. Performance is measured at the time of inputting, the measurement of inputs, what inputs are used and what is the output. Input output measurement is always done, but then while the performance is taking place, also the performance could be measured. So at the time of input, what is the input versus what is the output is one way of measuring. Apart from that, even while in performance also the performance is measured. What are the methods of reward? So methods of reward, when we understand that, we have to understand there are four different uh, types of rewards. That is, one is a fixed component. They would be paid a fixed um, salary kind of thing, a fixed pay, a basic pay. So irrespective of whatever is the situation, they are entitled to that particular fixed pay. Another pay is connected to their performance, so performance related pay. So as they achieve the targets or tasks given to them, they complete those tasks, then they are entitled to this performance related pay. Apart from that, they can also be provided with certain benefits. Then um, some of the organization, they allow their employees to participate in the um, share options. That is, they can become shareholders of that company. So the amount is the number of shares are allotted to the employees as a reward, as a bonus, and they can become shareholders. So that's another method of rewarding the employees on fulfilling their tasks. Then we see what are the management styles of budget. The management styles of budget, three things are there. First one is they're more focused on what fulfilling the budget, whatever is the budget which is decided, achieving the targets which are set by the budget. So the actuals are always on. We see that they work on par with what is planned for the organization. So budget constraint focus. Budget constraint focus. Um, Fulfilling whatever is the task which is given to them. So that's only for a short period of time. So if they fulfill the short period of time, that task whatever is assigned to them, they are content with that. But that will not look at the long term goals. Long term objectives are not uh, fulfilled there. Profit conscious management is the one who are focused on earning the profits in the long run. Now, fulfilling their targets, achieving their objectives in the long period of time. Short period of time, that's kind of a myopia. They are only looking at the current period, achieving the targets which are set for the current period. That's all what they are focusing on. But long period of time, sometimes when they are looking at the short period of time, the long run goals and objectives also can get affected because their decisions are absolutely related to the current period. So that is a danger with budget constant focus. Profit conscious people or managements are focused on achieving the goals in the long run. So it is not that in the short period they should become successful, but in the long run, how well do they perform? Then we have non-accounting performance evaluation. um, Apart from the financial perspective, the other non-financial performance indicators are also considered. So non-accounting performance evaluation is not linked to budgeted targets. So some of them are also focused on the other aspects like customer efficiency, no defects, scrap values, less safe environment, safety measures being taken in the organization, motivating the employees, training the employees. These are other parameters which also should be considered. It is not only the revenue and the profit which should be considered, but also the non-accounting performance evaluation is taken up by the managements. Then we see what are the problems of performance measurement. There are certain terms which are given there. Performance of um, just give me 1 second. Okay. The problems with performance measurement, we have certain terms which are listed there. Let's see what is the meaning here. I put another slide here. Misrepresentation, where the financial statements are altered. There is window dressing. There is this called also called as creative reporting. They are changed. I mean, the true picture is not projected or portrayed in the financial statement. So, creative reporting, gaming and sub-optimization, a form of dysfunctional behavior. So, um, they take up activities according to their suitability and convenience, and it's a dysfunctional behavior. So to get a personal benefit out of that, they are ready to manipulate certain things in the organization. Dysfunctional behavior, misinterpretation and myopia. Myopia is focusing only on one aspect or only on the short period of time. It is short-sightedness, so undue focus on financial performance. Whereas there are other parameters also which should be given importance. So when that is not done, that is called as myopia. Then measure fixation and tunnel vision, an undue focus on achievement of targets to the detriment of long-term performance. That's what we've seen under short-term objectives when they are considered. Sometimes that can cause harm to the long-term objectives, goals and objectives. Right? That is measure fixation and tunnel vision. Then we have ossification. Ossification is unwillingness to change scheme once set up. So they are not willing to make any changes and adopt to the whatever is the changed scenario. So that's called as ossification. Let's get back to the PPT. Now comes what are the financial performance measures in the private sector. Private sector, those organizations which work with the motive of earning profit. Profit motive, profit is the main motive in private organizations, private sectors. So when they're working towards earning profit, how do we measure the performance of such organizations? So the variables which are used here are ROCE. ROCE. Then we have liquidity and gearing indicators. Then EPS, EVI, TDA, NPV, IRR, MIRR. These things, almost all of them are already studied in some paper or the other. MA, FM, PM. These variables were already done. So it's not that you're learning them now. But maybe that interpretation part of it has to be looked into. So generally, the chances of asking you to do the numerical calculation for these things is little less. It's not that it is not there; it is little less because you were already tested about these variables. But if there is any variable which was not earlier tested, the chance of that being included in the examination is high. um, about economic value added, if that, since that was not tested earlier, there is a possibility that it can be asked in the exam. So that's how we understand, but it doesn't completely rule out that we cannot rule out that it will not be tested in the examination. If needed, you also should be prepared to do the calculation. But normally we see that the calculations are done and included in an appendix, and then you have to analyze, give comments, critically evaluate, something like that will be expected of the student. Now, what is ROC? ROC is return on capital employed, right? Um, there are the profitability measures which are considered. So profitability measures are all profit margins like gross profit, operating profit. Sometimes the term is used as net profit. So net profit margin. So all profit margins which are compared with sales. Sales is taken as the base, which is 100%. And what is the percentage of profit which is earned? So gross profit generally would be something around 30 to 40% because most of the costs which are incurred are towards cost of goods sold. So 60 to 70% of the costs are towards cost of goods sold. Production costs are very high. So we see that usually in a manufacturing unit, cost of goods sold is quite high, and then uh, the gross profit margin lies uh, in an idealistically speaking in a normal organization something around 30 to 40%. Then we see that other expenses like operating expenses are incurred, and then operating profit is derived. So find out what is the profit margin of operating profit as compared to sales. Then sometimes the term is given as net profit. So what's the net profit percentage? Or sometimes we also have to calculate individually each cost and what is the percentage of each cost. So various ways in which we can analyze the profitability situation by way of calculating profit ratios from the income statement. Each expense also is calculated as a percentage of sales. So it gives idea about what are the costs which are excessively incurred, and then the need to cut down on those costs. So that talks about the profit margins. Then we have ROCE. ROCE is about only two students are there. Oh my God. Which college are you? Arulin? Mispa? Which
We are
college?
from St. Agnes, ma'am.
Arulin. Mispa?
Yes, ma'am. We are from St. Agnes.
Both of you.
Yes, ma'am.
Okay.
Wait, where did Bansi go? Stop.
It's a problem with APM paper only. It's not only with your college. Everywhere we see that because it's not their immediate priority, we do not see the students attending APM classes, and then somehow they feel that it is not their immediate priority, so they need not attend APM. But they don't realize that the day when they have to actually write their exam, on that day there at that time there is no help which is provided. By then you would be out of the college, so the chance of you getting some kind of training from the college side is on a lesser side only. So
Yeah.
I don't know. I mean, it is not only with your college, we kids. That's why I keep checking on how many participants are there. Initially, I used to feel, I mean, no, they are not attending. But then I understood that because it is not their immediate priority, they don't want to take up this paper at this point of time. So when the time comes, they will start studying. That's a different story.
Uh,
Okay. Then ROCE is written on capital employed. So the formula talks about a comparison of profit with the capital which is invested, capital employed, profit and capital employed. But then critically, we have to remember one thing about profit um, has various forms. Profit is the operating profit, which is EBIT. Profit is profit before tax. Profit is profit after tax. Similarly, capital employed is uh, some opine that capital employed is the capital amount contributed by owners and outsiders. So debt holders and the equity holders, both of them, when they are contributing their amount of capital, that should be considered as total capital. So capital employed is both debt and equity.
okay.
Then some opine that since the real owners of the organization are the shareholders, therefore only the equity part of it should be considered. So profit divided by equity. So profit divided by equity is also considered as return on capital employed. So interchangeably, there are so many terms which are considered. That is um, the total capital, that is debt and equity, or there is a term called as investment that could be taken as capital employed, or the capital is raised to be invested into assets. So assets also can be taken as um, uh, the denominator. So ROCE, ROI, ROA, or ROE, return on equity. So they are interchangeably used. So you should be little aware of what can be the different forms of ROCE which are calculated. So every time you make a change in the numerator or denominator, the value of ROCE differs. So Then if asked, you should be able to justify which one is an appropriate one. So whether the total capital should be considered as debt plus equity, or do you agree with the equity as the capital employed? So your answer, your individual opinion matters there. So how do you justify? It is not choosing any one alternative and then writing that as your answer. Apart from that, you should also give a justification to that. So which one do you think is most appropriate form of calculating ROCE? Okay, that
Ma'am,
also you
how do you figure that out? Like, how do you figure out which and all formulas are appropriate for calculating? How do you find that out?
there is no standard formula for calculation of most of the ratios. Yes, there is a formula which is defined, but there are alterations allowed because the purpose for which the ratio is calculated differs from situation to situation. That's why we do not have standard ratios or standard values, ideal values for these calculated ratios. So there are not there. It again depends on what is the purpose of which these are calculated and how do we interpret. See, sometimes now for a ratio, liquidity ratios, for a ratio like current ratio, generally we say that an ideal ratio is 2 is to 1. Sometimes 2 is also not sufficient, like in a large scale operation, or the operating cycle is for a longer period. 1 year is not the operating cycle. Maybe the time required for them to finish their manufacturing itself is more than 1 year. So their operating cycle, if it is more than 1 year, they need to invest a lot into their current assets. So as high as 3 is to 1 also may not be sufficient in such situations. Then if there is no manufacturing activity, it is a service business, something like a financial institution or something, current ratio as much as 1 is to 1 is also considered as good. So we do not have standard values for the ratios. Then that's why the question of how do you justify comes into picture. So we have to consider what is the given situation in the case, and then which variable are you using, the numerator and denominator, and how do you justify why you're using those numerator and denominator is important. The various forms are given in terms of ROCE, ROA, ROI. These are various forms which are given to us, but which one is more applicable for that particular scenario, you have to choose that. Okay. Then how much profit is available on each share is the calculation of earnings per share, EPS. Then we have the asset turnover ratio. Turnover ratios basically indicate the efficiency. So whether asset turnover ratios, they indicate the efficiency because whatever is the investment into any particular asset, whether it is total capital, whether it is total assets, whether it is fixed assets, whether it is current assets, working capital, or individual items of current assets like receivable, stock, and all. So that basically indicates that whether they are able to convert that into turnover. Turnover, most of the time, it is sales. Most of the time, it is sales, but there are variations also against that. So it indicates the activity level. So if there is an amount invested into a particular variable, does it result in some activity being generated? Activities, whether sales are generated out of that amount, is turnover ratios. So turnover ratios basically talk about the efficiency activity of the organization. So that's how we have the higher the value, then it is better. Then we interpret that they are very efficient. Then we have also capital budgeting tools like NPV, IRR, and others. They are used to evaluate a project, whether it should be invested, the amount should be invested into the project or not. The students understand how to do the numerical calculation, but sometimes the questions can be asked about what is IRR, what is NPV, and then some marks are allotted to that. So, from the numerical question point of view, yes, the students are able to solve that. There is no issue with that. But then, if they are asked to express in words, that's where they find it very difficult. They do not, they are not able to express that. So, NPV at least can be done, but IRR, I mean, they do not know how to express it in words. So those things are also important because they are tested randomly here or there. They are tested about what is the meaning of every variable. So you should also understand how to express those concepts in your own words. The definitions are not needed that you learn them, memorize them, and then write it in the exam. That's not needed. But then you should be able to express it in your own words and answer those questions.
Ma'am, this profitability measures are taught in the eighth chapter of APM.
Yesterday you asked me, isn't it?
Actually, no, it was someone else. She was asking the same.
Okay, okay, someone else asked. Okay, let me also look at. I didn't open the study text only. Um, According to the units, the content just falls under fourth unit.
The thing is that, ma'am, in our college, we have already covered up chapters from 1 to 7. So we require like further training in 8 to 14th chapters of APM. That's why a lot of students don't attend the first to seventh chapters because it's already been
Okay.
taught. Yeah.
But this falls under eighth chapter, no? Financial performance measures in the
Yes,
private sector. I'll just put it on the screen.
yeah, sure. Ma'am, is
Uh,
it possible to teach us the eighth chapter tomorrow? Like financial performance in private sector or something?
Now what do I do now? All of you are from the same college?
I don't know. Fayaz Ahmed, is he okay with it?
All three of you are from St.
I'm
Agnes?
okay with it, ma'am.
I don't know about the other student. I don't know whether he's okay with it or not.
So this
Because
is in eighth chapter. Eighth chapter because financial performance measures in the private sector. Eighth, ninth, so on.
yeah, because we have already received training from first to seventh chapters, so we were very
Okay.
familiar with these kind of. We can brush up later, but we
Okay.
require urgent training from chapter 8 to chapter 14. I
Okay.
thought you could do the rest of the chapters, revise the rest of the chapters later.
Okay. But then we have another 1 hour time.
Yeah,
If
sure, you can cover this up for now. I think tomorrow we start with the eighth chapter.
I don't know, the topic what we've started just now is from eighth financial
Yeah,
performance measures. So that's in the eighth chapter. So if you want me to do it tomorrow, shall we do? Because all of you are from the same college and other college students are not there as of now.
it's
So
not.
I'll start this one tomorrow, fine. But then now we'll do. Um,
Yeah, you can cover up whatever you feel want to cover up today. I guess if you're comfortable, we can do the
we can start tomorrow. I mean to say that since we finished all the seven, brushing up all the seven units or seven chapters are also is done. So now it's the eighth one. So we'll continue from eighth till 14th at a stretch.
that.
Um,
Okay.
I'm suggesting that we do some case from the study text or something like that for the rest of
Okay.
1 hour time. Is that
Yeah,
fine?
sure. Yeah, that
Any specific topic which you would like to um,
that we can do that later. We'll just brush up with 8 to 14 chapters. Then we can revise from the first to 7 chapters. That won't be a problem for us. Because last semester we had the training, first to 7th.
yes,
So we
yes.
require that urgent training from 8 to 14. So when you were teaching the profitability measures, there was some familiarity with the 8th chapter. So I was asking this question.
This one is from, this is a part of eighth.
Yeah, this is a part of 8th. The
Uh,
EPS, gross profit margin,
that's right.
ROC.
So,
Yeah.
you want me to continue or you want me to do it tomorrow?
The 8th chapter, you can start it from tomorrow.
This is eighth chapter only, no?
Eighth
Common.
chapter, yeah, you can do it for now. I'll just tell all the other classmates to join in.
And now what?
So now we'll continue with this, man.
Yeah, we'll continue with
This
this.
is part of 8 only.
Eighth chapter, yeah. So eighth chapter will be over for now,
Okay,
and then
okay.
tomorrow we can go to 9th and 10th.
Done. I think we will even touch the ninth one also, because the focus basically when we are giving this ACCA training, our focus is to quickly finish with the syllabus part of it, because in detail explanation is all given to you in the college. We focus on taking you through the case studies, because those are the examination pattern questions, and then we help you out to understand how to answer those questions. So we don't give in detail explanation for these topics. So maybe I may also finish the ninth one today.
Okay.
Then 10, the remaining would be done
Yeah,
tomorrow.
tomorrow when the students join again, you can start from the 8th to 9th again, just for them to
Done.
catch up.
Quickly, I'll brush up
Yeah, other
with
topics.
those topics, and then
Yeah. Okay.
I mean, the beginning, the first class, I usually ask for anything specific requirement.
No, that's because other students came from St. Joseph, right?
Yeah,
So
that's
we
right.
thought it would be like rude because they must have started from the beginning. We have already finished the first to seventh. So we thought of
When
doing the,
the college was running at that time,
uh, sorry, ma'am, can you repeat?
these 7 chapters were done when the college was before the lockdown. Was
Yeah,
it then?
that was in the, that was in our fifth semester. This 8 to 14 chapters
Oh,
in the
okay.
fifth semester.
Okay.
So we learned this for our previous semester and
Okay.
we're learning this. But ma'am, you can teach us the previous chapters later on after we are done with 8 to 14 chapters. Just
Okay.
for a brush up.
Okay. Yeah, sure. Okay. Then NPV, IRR, those techniques which are used to assess whether the project is a profitable one or not. Right. Then yes. Then we have gearing and liquidity ratios. Gearing ratios basically talk about the capital structure, the composition of debt capital in the total capital. So, to measure what is the amount of debt capital and what is the impact on that. Uh, so, broad classification of capital. There are 2 types of capital. That is, one is debt capital, and the other one is equity capital. In terms of cost, debt is a cheaper form of capital. So the cost is less in case of debt capital. And if it is risk, the risk is very high in case of debt capital. The reasons why risk is high is because of that obligation to make the periodic payment on the debt capital is one reason, and there is a maturity for debt capital at the end of the life of the debt capital. The amount should be repaid to the debt holder. So on account of this, risk is high, but it is a cheaper form of capital. The cost is less on debt capital. The day when it was issued, so the interest rate is decided something which is on par with the prevailing rate of interest in the market. But the same rate applies till the throughout the life of the debt capital. So it is relatively a cheaper form of capital. But in case of equity, the risk is low. Why is the risk low? There is no obligation to make a dividend payment. When profits are available, dividends are paid. When profits are not available, they are not paid. And in case of equity shareholders or common shareholders, the profits are available, still the amounts are not paid to equity shareholders on account of retaining the profits, so that these profits can be used for reinvestment and other purposes to meet the contingent liabilities and all. So the obligation is not there on equity. The commitment, the that fixed commitment to make a payment is not there. Okay, so the risk is low, but as compared to the cost part of it, it is much costlier than the debt capital, because the shareholders have an impact on the organization or the management to see that they earn better returns to them. Only when they have better returns, when the profits are good, they are satisfied. When the profits are good, they continue to be the shareholders or investors of the company. Otherwise, when they are not satisfied, then they withdraw their capital from the organization. So withdrawing capital from the organization is a risky thing. That is when they start selling off the shares, the demand in the stock market falls and the price of the shares also fall. So to see that the shareholders are satisfied, um, the organizations end up earning better profits to them. So whatever profits are earned for the shareholders, that is the amount which will be eventually distributed. If not immediately, eventually it will be distributed. So the return which is earned by the company for the shareholders is the cost which they are bearing, the cost which they would be paying. That is what they have to distribute. Okay, then they are under an obligation to earn better returns. So the cost on equity is high because the shareholders have to be satisfied, but the risk is low. Okay, technically we say the risk is low, no obligation to pay, but there is an obligation to earn better returns. Fine, therefore the cost is quite high. In this scenario, we have to compare with these two types of capital. What is the proportion of debt capital versus what is the proportion of equity capital in the total structure? So debt versus equity. So debt, too much of debt indicates that the risk is high in the organization. They have invested a lot of amount by raising debt capital. If equity amounts are more in an organization, they are not taking measures to cut down on their cost. The cost of capital, they are not taking measures to cut down on the cost. Why? Because equity is a costlier form of capital. They should think about investing or raising some debt capital and invest in the business. So from the case study, we have to look into the data which is provided to us, that is appendix or financial statements or some mention about what is their uh, capital structure. You should be able to comment on that. Maybe you have to advise about they using their debt capital more or reduce their debt capital, increase whatever is the a combination of debt and equity capital. You should be able to comment about that, because the nature of the characteristics which are associated with debt capital and equity capital in terms of cost and risk, you should be able to present it there. Fine. That is one aspect of gearing ratio. There's another aspect of the cost on debt capital being as a fixed cost. It is fixed. Once the percentage of interest is decided on debt capital, that is a fixed percentage applicable till the end of the debt capital, end of the life of debt capital. So that's a fixed cost. But in case of dividend paid to equity shareholders, it is not the same thing. It may vary from year to year, because the decision is taken about dividend payment in the um, annual meetings or the meetings which are conducted for the shareholders. Then they take a decision about that. So the cost of capital uh, for the debt holders is fixed. For the other investors, it is not fixed. So it is variable. Then when we separate the cost of capital in terms of variable and fixed, what is the impact this variable cost and fixed cost have on the gearing ratio is what we have to understand. So the first one talks about um, the financial gearing, about employing long-term debt versus the shareholders funds. So that's one aspect. The operating gearing talks about what is the proportion of fixed cost and variable cost. So the fixed cost and variable cost part of it, let's just look at quickly. Let's look at this one. Um, Sales minus sales minus cost of goods sold is gross profit. From gross profit, operating expenses are deducted, then we call that as a operating profit. Operating expenses are deducted, then operating profit. From the operating profit, interest is paid, which is on debt capital. This is operating profit minus interest. Then we see the tax amount is paid, then the amount is available to the shareholders. So, operating profit is also called as EBIT. Interest is a fixed cost, so it will not change. Then the resultant figure is EBT, earnings before tax. Suppose there is a change in the sales. Let's say that sales amount increases. Now sales from this cost of goods sold. Cost of goods sold is a percentage which varies with the changes in the sales. So cost of goods sold is deducted. Gross profit also proportionately increases. Then the operating expenses are deducted, and then we see that EBIT, because EBIT also keeps increasing till here. We see that even the EBIT also increases proportionately, not proportionately also. Still there is an increase. But then now here, with the increase in sales, we do not see that interest is increasing. Interest would be the same. Therefore, what impact does the increase in the sales activity has on EBIT? So, increase in EBIT has when that is compared with the EBT, it is not a proportionate increase. Why? Because interest is same. Interest would be same even when the activity increases or decreases. So a way to calculate the financial leverage or gearing is by comparing what is EBIT versus what is EBT. EBIT and EBT, the percentage change which has happened, whether that is reflected in EBT. Why? Because of the nature of interest being a fixed cost. So fixed cost will not change till the relevant range. It doesn't change in the relevant range till um, they utilize till the optimum capacity, till they you produce up to the optimum capacity. Fixed cost does not change. So till their sales level reaches the maximum capacity level, their fixed costs do not change. So one aspect of financial gearing is focusing on what is the interest amount, and then another aspect of it is here under operating cost, we have few costs which are fixed costs and few are variable in nature. So the fixed cost, the fixed component doesn't change. Only the variable component keeps varying with the changes in sales. So there is a way of calculating what is the proportion of fixed cost versus variable cost. So that is important to understand what are the fixed costs and what are the variable costs. So when we calculate the gearing ratios, one gearing ratio is in term of the financial costs. The financial costs are which are paid on the capital, the cost of capital. So one cost of capital, which is interest cost, is fixed. The other ones are not fixed. So what impact does this fixed cost have on EBT when it is studied? We call that as financial gearing. Then operating gearing talks about what is the proportion of fixed cost and variable cost. Very intricately, very in detail, it may not be tested in APM because it's a part of other papers like FM, AFM, and then a part of it goes under management accounting and also. At this point of time, they may not, but if there is something related to, we are observed that there are too many variable cost or too much of fixed cost income. So what impact does it have on the decision making? Maybe we should be little aware about that. So once the fixed costs are absorbed, they are recovered, the rest of it is all profit, because fixed costs will not change till they reach the optimum capacity. Therefore, lot of fixed costs, if they are used in an organization, in the long run, once the fixed cost are observed, the profits would be high. The only condition is the demand should be there for those products. So if the demand is high and the fixed costs are also high, it is better for the organization, because they have they have the possibility to sell many number of units, and as soon as the fixed costs are recovered, the profits will be high, because the sales minus variable cost is contribution minus fixed cost. So no longer this fixed cost. So all contribution is considered as profit in that situation. So mention about what is the proportion of variable cost and fixed cost, what impact do these costs have on the profitability, is what you should be able to comment at this particular point of time. Then we have the liquidity ratios. Liquidity ratios like current assets, current ratio, quick ratio, absolute liquid ratio, that's cash ratio, inventory turnovers, receivables turnover, all those current assets and current liabilities related ratios. Um, we should be able to calculate and comment on that. So more than the calculation, I think it is about the um, interpretation which is important. Then we come to another topic called as responsibility accounting. Um, See, the organization as a whole, to measure the performance, it's not possible, because there are multiple activities, division, multiple functions which are carried on in an organization. So in such a case, to measure the performance of the entire organization is not possible. For that reason, the organization is decentralized, or it is divided into various strategic business units. So these strategic business units, or what we call it as departments and divisions, for each of them there is a manager appointed, and he's assigned with some authority. With the authority, he has the decision making ability. It is not about only assigning authority, but with the authority, whatever decisions he takes, he's also made responsible for that. So accountability comes into picture. So now responsibility accounting is about um, the the accounting of planned and actual information. So he has to plan, the manager has to plan for the strategic business unit, the department. So accounting which takes care of accounting the planned information. Planned information is whatever planning is taken up. So that planning has to be accounted for. It's not only accounting the plans, but when the actuals take place, the actuals also should be accounted for, and the accountability of the department comes into picture, because there would be a comparison between what is planned and what actually happened. So there is a comparison between planned and actual, and if there are deviations, then that accountability, that responsibility to take up the responsibility comes into picture. So responsibility accounting is a system of accounting based upon the identification of individual parts of a business which are the responsibility of a single manager. So the manager is responsible, but what is he responsible for? So he's responsible for planning for the unit. He's also responsible when the actuals take place, because the actuals are compared with the plan. So the accountability comes into picture at that point of time. Then an organization chart must be drawn up in order to implement a budgetary control system. Ensure each manager has a well defined area of responsibility and the authority to make decisions. There are no gray areas. These units are also called as responsibility centers. There are three different types of responsibility centers: a cost center, a profit center, and an investment center. We'll see what are the features of these things and how are these responsibility centers evaluated. We'll see that in the next slide. Then a responsibility accounting system is required to trace costs and give cost information to the relevant budget center. Why are they divided into responsibility centers? So that the performance can be evaluated. So for the purpose of evaluating the performance, they are divided into responsibility centers, and according to the type of responsibility centers, they are categorized as cost center, profit center, and investment center. There are certain units or centers where they incur only cost. There are no revenues which are generated, so it's only cost in incurring units like production, like administration, HR. These units do not generate any revenue, so they just incur cost uh, to complete the task which is assigned. So it's basically about incurring cost and having a cost control. How is the manager held responsible for that? Now, what are the measures which are taken? So, the decisions that incurs cost but has no revenue streams, they are evaluated based on the types of costs which are incurred. Um, at this point of time, you should understand that there are variable costs which are incurred. There are fixed costs which are incurred. Variable costs and fixed costs. Variable cost is a cost which varies proportionately with the activity, with the output, with the number of units produced. Fixed cost does not vary with the activity; it remains fixed. But but out of that fixed cost also, fixed cost can be categorized as traceable fixed costs and unavoidable fixed costs. So fixed costs are also two different types, that is traceable and unavoidable fixed costs. So what are traceable fixed costs? Suppose an activity is suspended. A part of the fixed cost also can be eliminated. Let's say that if there is in a particular production activity, there are two supervisors supervising the work. If a decision is taken to cut down on the production, so if they decide to bring down their activity level, in that case, two supervisors may not be needed. If it is sufficient that only one supervisor is appointed and he takes care of that. So when the activity is cut down or it is decreased, um, some of the costs, though by nature they are fixed in nature, some of the costs can be eliminated. So when you can eliminate fixed cost, we call that as a traceable fixed cost. Right? Then there are certain costs which are not at all controlled. So there are some costs which do not decrease with changes in the activity, unavoidable fixed cost. Apart from that, we also have another type of cost which is called as allocated fixed cost. Allocated fixed costs. So what are those allocated costs? There are certain costs which are not incurred by individual departments, but they are incurred by the organization. Like top management salaries, establishment charges, and all. They are incurred for the entire organization. But when the organization is divided into various subunits, these costs which are incurred for the organization also are divided and they are allocated to the units. So then um, they have to be accounted for by these individual units. Yes, they are not incurred by them, they are incurred by the entire organization. They are allocated to them, they are charged to the units. So they should also take up the responsibility of these allocated fixed costs. So at the time of evaluating their performance, the measurement of performance, the measurement should include the presentation in terms of how many variable, what is the amount of variable cost, what is the amount of traceable fixed cost, um, unavoidable fixed cost, the cost which is allocated to them because it is incurred for the entire organization. Then some of the costs which are shared with other units, they are divided and distributed. Those costs, all these categories we have to understand. So in a cost center, what is the criteria? Cost center, if whether or not they are able to cut down their cost is the criteria, because there's no sales or revenue which is generated. So they are considered as effective if they can cut down on the cost. And the responsibility is also there. It is not only about some action which is taken, but for whatever are the actions which are taken by the unit, the manager is held responsible. So, one more important point what we should remember is to what extent is the manager held responsible? He should be held responsible for the decisions he takes. Some costs which are allocated to them, he has absolutely no say in what should be the amount of cost which should be allocated to their department, that their unit. That is not in their in the purview of that department manager. So the accountability should not be there in terms of those costs. So that part of it we have to be careful about it. So what are the typical measures? How much is the total cost which is incurred is one way of measurement. What is the cost variance? So what is the plan? What is the planned cost? How much cost should be incurred is planned versus what actually was incurred. So is there any variance between um, planned cost and actual cost? And then if there are variances, then those variances are understood as to whether they're favorable, unfavorable, and the accountability comes into picture at the time of variances. Then what is the cost per unit and other cost ratios? So each cost calculated as a percentage of sales helps us understand whether specific cost is incurred more or less can be understood. So when they are calculated as a percentage of sales, it helps us to understand what is the percentage of cost which is incurred. NFP is a non-financial performance indicators, non-financial performance indicators related to quality, productivity, efficiency, etc. Those things are also accounted for in case of cost centers where they incur only costs and do not generate any revenue. Profit center is a center where they incur costs, they generate revenue. So revenue is generated, cost is incurred. So sales minus cost is called as profit. So since they are generating revenue and incurring cost, there would be some amount of profit. So those centers are called as profit centers. So how do we measure the performance? So they should take measures to generate more amount of sales. At the same time, they should also take measures to cut down on the cost so that the profit is at maximum. So sales, to generate sales and to cut down on the cost will result in better profits. And all cost related measures are applicable here. Apart from that, what are their sales and profit? What is the amount which is generated from selling the units, and what is the profit margin which is earned? Because the cost price plus profit is sales. So it's not always that profit is high because sales are high. It could be because the profit margin which is added to the cost price also could be high, right? Efficiency is considered when more number of units are sold, the sales is high, not when higher profit margins are added. So efficiency aims at making more amount of sales. That is efficiency. It is not adding high profit margins. So that's kind of a risky decision because once the customer feels that the price is quite high, they may shift to the competitors. So that's not efficiency. Okay, sales variances, margins, market share. What is the customer base which they have captured? To how many customers are they selling products and all? Talks about the market share. Then, what's the market working capital ratios? Depending on the division concerned, the working capital talks about current assets and current liabilities. Most of them are associated with um, selling goods on credit basis, and then buying goods on credit basis, which are included as accounts receivable and accounts payable. So the ratios which are associated with calculation of working capital is also important. Then the third type of center is called as an investment center. Um, Within an organization, normally investment is made in a combined form. So when once investment is made, it is invested in more than one unit, more than one department. But in certain cases, the investment made in a particular department is exclusively identified with that department. The investment is only made in that particular department separately. That other investments are incurred either separately or jointly with in the other department. But if there is a unit, if there is a profit center in which the investment is also identified with only that particular profit center, then such profit centers are also called as investment centers, because the investment is not a shared investment, it is exclusively invested in that particular center. So then we call such centers as investment centers. Okay, investment is made exclusively in that particular unit. It's not a combined or shared investment, it is an exclusive investment made only in that particular center. Then they would be involved in cutting down on cost and generating revenue. Apart from that, so they have cost, they have sales. So as a result of these things, they also generate profit. So basically, they are profit centers, but because investment is also there, so investment also should be considered. How are they evaluated? How is the performance measured? Because investment is identifiable, okay, the revenue which is generated is associated with the investment made. So there is a comparative study about how much revenue is generated on account of investing in the business. So that's called as uh, ROI calculation and RA calculation. Both of them focus on one thing, about the profit which is generated. The first one, ROI, the profit which is generated is as a result of the investment made. So it's a comparison about profit by investment. it is identifying that they were efficient enough to make some profit for the amount of investment which is made. So it's a percentage calculation. So investment is taken as the base, and the profit which is generated is what percentage. Then we have the next formula called as RI. RI, the full form of RI is called as residual income. Residual means leftover or remaining. That's the meaning of residual. So residual income formula is about the profit which is considered is operating income or operating profit. We also call this as EBIT. So from the EBIT, if the cost of capital is deducted, now cost of capital has to be paid to the investors, to the debt holders, to the equity holders, profit has to be paid. So from the profit, the cost of capital also has to be deducted. Cost of capital is paid to the outsiders, debt holders, investors, that is other investors, that is shareholders. Dividends are paid. So cost of capital has to be paid. So from the operating profit, if cost of capital is paid, is called as residual income. Okay, operating from the operating profit, if cost of capital is paid, so whatever is the remaining amount is the residual income which is available, right? So these two measures are used in case of investment center, that is ROI and RI. These are the tools which are used for evaluating or measuring the performance in case of an investment center. Division has both costs and revenue. Manager does not have the authority to invest in new assets or dispose of existing ones. Um, these are explained in detail here. What is ROI? Um, at the time of explaining ROCE, I also told that they're interchangeably used with ROI, ROA, ROE. All these things are used interchangeably because the numerator is focusing on the profit which is available. Denominator is about the capital employed or the investment made or investment made into total assets. So it's a percentage calculation, profit, controllable profit or operating profit divided by controllable capital employed into 100. Residual income talks about the controllable profit minus imputed interest on capital employed. So that is cost of capital. So cost of capital, when it is deducted, the resultant figure is called as residual income. Another topic what we have here is economic value added. Economic value added is EVA. So economic value added, how is it calculated? The formula for economic value added is given here. It says that first step is calculate what is NOPAT, net operating profit after tax. From that deduct the cost on the capital employed which is available at the beginning of the year. At the beginning of the year, at the start of the year, whatever is the capital employed, on that cost of capital is calculated. So that cost amount is deducted from the net operating profit after tax, and the resultant figure is called as the economic value added. So if in the case it is given and we are supposed to calculate this, we have to do this calculation in the case. The chance of a numerical question being tested is there because I think it was not done earlier in other papers. How do we calculate what is NOPAT? The capital employed is, we'll come to that point. I'll explain. I'll explain why we are adjusting, because there's so many adjustments which have to be taken into consideration. We will do that one. But first, let's start with what is NOPAT. Okay, what is NOPAT? The net operating profit after tax. But when is tax calculated? Tax is calculated after the interest amount is paid. So here the NOPAT talks about the operating profit which is considered and the tax is calculated. But the normal way of calculating profit after tax does not eliminate the non-operating incomes and expenses. The normal way of doing that. Let me put it to income statement. Let's quickly see what is the income statement. Sales minus cost of goods sold is called as gross profit, and from this minus operating expenses is called as operating profit. Then there are certain non-operating expenses and non-operating incomes also. So minus non-operating expenses. So what are non-operating expenses? Non-operating expenses are like loss on sale of assets, then impairment loss, so economic depreciation. These are all non-operating losses, because the main operation of the business is to buying and selling, buying of raw material and selling of finished goods. That's the main operation. Anything which is not a part of this is non-operating. See, they are into buying of raw material and selling of finished goods, but selling of assets is not their main operation. So if an asset is sold and there is a loss which is incurred, that is a non-operating expense, right? Um, impairment is a term where economic depreciation is a term where the assets are accounted at book value and depreciation is provided periodically. At any given point of time, the value of asset which exists in the books is called as net book value. This one indicates that on sale of the asset, the amount which should be realized is the net book value. That is what it indicates, the net book value. So on disposal of the asset, it should realize this amount. Fine. Then if because of changes in the market, technology, all those things, if the asset cannot generate that amount of book value, if it is very less, then the book values are adjusted from time to time. Periodically, they are evaluated and they are adjusted according to the market value. So whatever is the decreased value in the value of asset is adjusted, which you call it as economic depreciation, impairment. These are terms which are used. Then non-operating expenses are deducted and non-operating incomes are added. Like gain on sale of assets, then some unrealized gain which is realized, commission received, dividend, interest received. These are all sources of income, but they are not the main source of income. The main source of income is only sales. That's the operating income. The main source of revenue which is generated is by way of selling goods. But if they have invested amount in some other investment, some income is received on that is non-operating income. So from the operating profit, these two items which are adjusted, then we call this one as EBIT. Okay, so EBIT is not EBIT is after deducting operating, non-operating expenses and adding non-operating incomes. Fine. Let's get back to the slide. So when we calculate the NOPAT, so start with the controllable operating profit. Controllable operating profit, from that all which was not uh, under the account of operating expenses and income should be adjusted. Earlier if that they were deducted, added back. Now earlier if they were added, now deducted. So arrive at the amount which is operating in nature. Then finally deduct the tax amount, and from the operating profit calculate the tax and deduct the tax amount, and the resultant figure is called as net operating profit after tax, because it includes only the operating transactions. Net operating profit after tax. Then from the net operating profit after tax, the cost of capital is calculated and deducted. Now, the cost of capital is calculated and deducted. The cost is WACC, the overall cost of capital on all types of capital. So that is applied on the adjusted value of capital employed at the start of the year. At the start of the year, whatever is capital employed also can go through certain changes. The changes in terms of um, the adjustments, book adjustments which are done. That is an adjustment to reflect the replacement cost of non-current assets, adjustment to reflect economic and accounting depreciation. But when the cost is paid on the capital employed, so whatever is the value of capital which exists at the beginning of the period, on that it is calculated, not after all the adjustments are done. But they are subject to all the adjustments which take place. So that will have an impact on what is the capital employed, like economic depreciation, uh, uh, then certain adjustments of because equity is one section where the capital contributed capital is there, the accumulated profits are there, the adjustments to the profit accounts are there, and then these all types of gains and surpluses which are generated, all of them come under the um, section called as equity. So we are only focusing on what is the amount of capital paid in capital, the capital which is contributed. On that, the cost of capital has to be calculated. Fine. So we are not considering any other adjustments which took place during the period. So at the beginning of the period, what, because that's the base. Base is at the beginning of the period. On the base amount, the cost of capital is calculated, and that is deducted from the net operating profit after tax. So we are only focusing on the operating transactions of the business. The resultant figure is called as the economic value added. Okay. This is another measure which is used for um, calculating or for the measurement of performance. I think we should stop here. The rest of it we will do it tomorrow. Is that fine? Okay. Any doubts? Any doubts?
Yeah, ma'am, that actually asked the question, right? The value of capital employed at the beginning of the year.
Yeah.
Could you just elaborate on that?
Um, at the beginning of the period is the base. Generally, that is taken. The opening capital and closing capital are two aspects. So, opening capital, on the opening capital, the amount of cost is calculated, but the capital can get adjusted on account of various things, and then that is reflected in the closing. Why would we not do that? Is the adjustments are not for one full year. Throughout the year, sometimes these things happen, and that is as a reflection of the current year's activities that these adjustments are made to the opening capital. But at the beginning of the period, whatever is the investment made, on that cost of capital is calculated. It is not periodically whatever adjustments are done, not deducting those adjustments and then doing calculating. Technically, now this cost of capital is an imputed cost of capital because it is not actually they are paid. This is a calculated figure, always cost of capital. So, in case of a sole trader, when we say interest is paid on capital, technically there is no amount which is paid. And when we use the percentages and calculate cost of capital also, it is not exactly the payment is made to the capital contributors. It's not there. But now theoretically speaking, how do we calculate what is the value which is added